Hey guys, welcome back to the channel. Hope you all had a great week. Today we are covering an ETF that I've been meaning to cover for months and months and months. It's an extremely popular ETF. I like it, but there's some hitches with it, and I'll explain to you why. Because I'm a big proponent of passive investing, right? Even though I trade a lot of options, which is active investing, but I like to have my portion of passive investing. And this ETF we're covering today, great ETF. You can tell by the title, it is the NOBL Dividend Aristocrats ETF. Dividend Aristocrats, like we all know, been paying dividends for at least 25 years consecutively. And it's a small universe overall of stocks. We'll dig into it and I'll give you my opinion on it. You know, again, I'm not a financial advisor, blah, blah, blah. You know the drill. So if you're new here, please like, share, subscribe, do all that good stuff. Leave me a comment down below. In the pinned comment down below is ways you can support the channel. I would appreciate it. I know quite a few of you did, especially on last week's video. You guys are awesome. I will definitely put it to good use. So let's dig in. So what are we talking about today? We are talking about ticker symbol NOBL, NOBL, and that's the ProShares S&P500 Dividend Aristocrats ETF, labeled as a large value equity ETF. Has $8.29 billion in net assets. Net expense ratio of 0.35%. Not showing a dividend yield here, but it's right at about 2%. No, it's not high, but you know, we'll get into that. Okay. So what is NOBL? NOBL Dividend Aristocrats, and we'll go down here, look at the portfolio composition. First thing I want to point out though, price to earnings. What's nice about this Fidelity site is sometimes these PE ratios are hard to find. They're not everywhere, especially on ETFs. But what that is it takes an average of all the holdings in the ETF and gives you an average PE of the entire fund. And for NOBL, that stands at 25.28, which is, to me, a little bit high. But you know, we've had this rotation into value here recently and has kind of driven this fund up. Oh, there's the distribution yield right there as of April 30th, 1.93%. So let's look at the portfolio composition. We'll see what it's consisting of, right? First, we'll look at this. We'll just do an overview of what the Dividend Aristocrat is. So a Dividend Aristocrat index is S&P 500 companies that have increased dividends every year for the last 25 consecutive years. So the index equal weights all these companies. So I think there's about 66 of them. They have to have 25 years. They must have a float adjusted market cap of at least $3 billion. So they're going to be fairly large companies, right? Got to be liquid stocks, and they have to be diversification for the index. Each rebalancing, the minimum number of constituents should be 40. I don't know what they would do if it went under 40. I don't know if the index would go away or what, but you know, what if, I think there's 66 companies right now. What if it was 39? What if all of a sudden everybody cut their dividend? I don't know what they would do at that point. That'd be kind of interesting to know. But you know, NOBL, here we go. Index contains a minimum of 40 stocks, which are equal weighted. No single sector is allowed to comprise more than 30% of the index weight, which is important because when you're dealing with a smaller number of holdings, you don't want it heavily weighted in one area just in case something happens in that sector. You don't want it to affect the entire fund extremely on the extreme end, if that makes sense. So we'll go down here, top 10, 15.875%, 15.87%, sorry, and 84% in the other ones. Like I said, total holdings is 66. In the top 10, we got some, really stable companies, right? Archer Daniels Midland, that's a food processing or kind of grain, deals with food worldwide. NUE is a steel manufacturer. ALB, I think that's a materials maker of some sort. Cincinnati Financial, Bank, ExxonMobil, Oil, Roper Technologies, I believe is some sort of manufacturing. FRT is a REIT. Cisco is food, again, food. WW Granger is parts, industrial parts. And Genuine Parts Company is automotive parts. So really things that people use every day, need every day, and usually those end up being the most stable investments that you can make, right? 95.39% is in North America, with 4.6% in Europe, mostly in the United States. Large cap is 61.29, mid cap 37.2, small cap 1.5. Now sectors is interesting. Consumer staples, 20% in consumer staples, like I just said, things that people need. Industrials, almost 20%, again, usually producing things that people need. Materials, again, same thing, 12.3%. Financials, just under 11. Healthcare, just over 10.5. Consumer discretionary at 9. Real estate at 4.6. Utilities at 4.5. Energy at 3. Info tech at 2.99. Communication services at 1.5. Now you'll notice the one con of holding something like this is you'll get some growth, yes, but usually a lot of these places are kind of slow growth, steady companies, steady 80 companies, right? What you're not going to get much is in information technology. With only 3% of the fund, this is where I think this wouldn't fit as a core holding. This would be a satellite holding. You'd want your core holding, in my opinion, to have a heavier weighting to information technology, because I think that's what's just going to continue to drive the world as we know it. So another one that's like this, we'll get to that. So Morningstar large cap value blend. Now, I always like to look at compare funds to similar funds, right? And what I'm going to compare it to here is a fund I did a while back, and it's actually by the same ProShares, but it's called REGAL instead of NOBL. And REGAL is the mid-cap aristocrats. I think the mid-cap aristocrats have the rule of being 20 years of increasing dividends. I'll link to that video up above and down below. But they run very similar strategies, and I think you can hold both of them, right? So if you look here, I got NOBL up on the screen, and we're going to check out REGAL and see how they've done against each other for the past 6 years. Looks like NOBL has, just eked out a gain over REGAL. I like both of these indexes. At least with REGAL, you may get exposure to more quality companies, right? To where this can be a complete portfolio, but it's still lacking technology. So you can own both NOBL and REGAL. The advantage to that is you look here over on ETFRC.com. I'll leave a link down below to that. This could check overlap, and you can see NOBL and REGAL. Click find overlap, and you'll see 0 number of overlapping holdings. So, none of NOBL's holdings are in REGAL, and none of REGAL's holdings are in NOBL. So you'll have a big, what is that? About 110, 115. No, that's like 110. 110 holdings that have been paying dividends for at least 20 years straight, increasing their dividends for at least 20 years straight, and you'd have exposure to all of them with buying both NOBL and REGAL. Now, I know a lot of you expect me to just have investments that pay, 8%, 9%, 10%, 12% dividend yields, even 35% dividend yields, right? But I think your core needs to be, and I think this applies to most people, your core needs to be, as you're building up your portfolio, it needs to be in dividend growers, not necessarily big yielders. And that's what you get with NOBL and REGAL. So if we look here to the dividend scorecard on Seeking Alpha, NOBL has a 5-year growth rate of 11.63%, right? 1.9%. It's low, but it's growing at an average rate of 11.63%, over that 5-year period. And we look over here at REGAL, and it has almost a 2% yield, and it's growing theirs at 16.48%. So why is that important? Well, if you're looking at a lot of the income funds, right, they're not going to be growing their dividend very much. You can manufacture your own dividend out of those income funds. So if you were taking out as income, you'd want to put back in a certain amount. I haven't figured out the math, but I'm just off the top of my head, 20% sounds good. So whatever you're getting from your income funds and you're spending and living on, you want to reinvest back at least 20%. That way you are manufacturing this growth rate within that income fund. I hope that makes sense. So, if QILD is paying you $2,500 a month and that's what you need to live on, you may want to add a little bit more to QILD so that you can get more than 2,500, so you can keep building the position up and keep building your income up to have a growth rate in your income coming in. I hope that makes sense. So, this is not, I know my channel's been known for high yielding and stuff like that, but funds like this that grow your income is really important to have, in my opinion. I'm personally invested in DGRO, DGRO. I'm looking to build that position up. If my count gets a lot larger, I may, split it up into some more things like NOBL and REGAL. I think they're great investments for what they are. You get, like I said, 100 plus companies exposed to you that have been paying dividends for 20 plus years, increasing dividends for 20 plus years at good dividend income growth rates. So that's NOBL. That's my opinion on it. Leave me your opinion. Leave it down below. Like, share, subscribe, do all that good stuff, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.